Hi. So in the previous video, okay, we saw what are the four types of derivatives available in the market, okay, financial market. So basically in this video we are going to check, okay, what is futures and what is forwards, what are the differences and what are the benefits. This is what we are going to check as per the NISM series, okay. So let's understand what is forward contracts. Okay, so basically in a previous video as we referred, basically this is a contract between two parties to buy or sell an asset at a specified price in a future date. Okay, so basically it is a contract. So forward contracts are used for our hedging purpose. Okay, hedging purpose, although okay it is non-standardized nature, okay, makes it particularly opt for a hedging. And as we saw, this is okay basically over the counter it will work. Okay, so basically it will happen in a over the counter. So if you did not watch the previous video, please refer the previous video so that it will be very clarity that will give you that will make you sense. Okay, so what we do here is, okay, we will make a contract in between us and shopkeeper for a particular amount. Okay, so let's go with the example for this. We say, okay, we had a rise of current price, okay, is rupees 60 rupees per kg. Current 1 kg is 60 rupees. Okay, but we know the price is going to fall, okay, in upcoming months. Maybe the demand gets less. Okay, it's just an example. Okay, so the demand gets less. Okay, so the price may fall down, and or the productivity become more compared to the demand. Okay, so the price will go down. So this is what we know, because as a farmer or as a field person, okay, you know what will happen, and you know the current condition of the market. So basically, so you know this. Okay, so what we do, okay, we will make a contract in between, okay, us and shopkeeper, so that we can sell for a whole year or whole 3 months or 6 months period for a same 60 rupees. Even the price fall down to 50 rupees, okay, after a month, so we are protected, so we will be safe, we will receive only 60 rupees. Okay, okay, but if the price went to 80 rupees, then too we are going to sell it for a 60 rupees. So this is how basically hedged works, and this is what will happen in a forward contracts. Even the price goes up and even the price goes down, whatever the price we agreed to sell, we are going to sell it. Okay, or whatever the price we are agreed to buy, so we are going to buy it. So this is how forward contract works. Okay, so just take it as a keyword and keep it in your mind always. Okay, that is the reason I came up with the example. So now understand what is future contracts. So basically future contract is a agreement, okay, to buy or sell an asset which is traded in a publicly. So publicly in the sense where in a stock exchange. So this forward contract is happening in a offline, but future contract will happen in a online, that means to say in a exchange. Okay, this contract specifies, okay, when the seller will deliver the asset and what will be the price. Okay, so basically, so if you are trading in a future, okay, you will know there will be a physical delivery available. If for example, if you want to say if you are trading in a crude oil or a natural gas, so there are physical delivery available. So they will ask you to they will ask you to square off the position when it is nearby expiry. Okay, so if you are trading in a future, you might get to know. If you don't know, this is the information I'm giving to you, please get to know. Okay, so basically future contract is a underlying asset of the future contract, commonly either a commodity or stock or bond or currency. Okay, so all these things will be the future contract will be available in an exchange. So future markets are highly liquid, okay, compared to the, okay, compared to this, because basically this is only two people conversation. But here, okay, when it come to online, so basically, so that will make a high liquidity compared to the forward market. Okay, compared to the forward market. So we understand what is the difference between forward and future. So as we saw before, okay, forward contract is basically between two parties. Okay, but future contract which will happen in a online, so it might, there are multiple parties get involved. And okay, so a contract, the party agree to exchange the asset or cash at a fixed price at the future specified date. Okay, so here the future contract. So basically forward contract, okay, it's a tailor made contract so that they can modify, okay, whenever they want they can modify. So why I mentioned the tailor-made contract, because they can alter it. Understood? The tailor will alter it. That what tailor do? They alter it. So they can modify it. But this is a standardized contract. Okay. So we cannot modify anything. So whatever prefixed by exchange or SEBI, whoever, only those conditions will apply, and accordingly we need to buy or sell. Correct? So forward contract will happen, okay, in over the counter, but future contract will happen in stock exchange. Okay. So forward contract settlement will be on maturity date, but here you can do it on a intraday basis. So I hope you know. So in future we can do intraday basis, and forward contract will be highly risk. Why highly risk? Even the price goes up, heavily up, okay, you will be in a losses. Correct? Even if it goes heavy down, okay, then too, okay, you may feel that it will be very good. Okay. So that, but here, okay, basically it is like if you are selling rice, if you don't want to sell it for a 60 rupees, okay, and that goes spoiled. Okay. So that is basically highly risk. But in future contract it is lowly risk, and this size, okay, forward contract size depend upon the contract. You can sell it for 100 kg also, 200 kg also, but here no. Future contract lot is already described. Okay. So it will be a fixed. Correct? So we buy it as a lot. Correct? So it will be fixed. So basically for making this contract, forward contract, we do not need any initial margin, but if you want to trade in a future contract, you need an initial margin. Correct? Okay. So basically forward contract is self-regulated. Why self-regulated? It is happening in between one person to other person. So it is basically as per their negotiation, it can be altered or modified. Correct? But future cannot be altered or modified, because it is derived by stock exchange. Okay. And risk, okay, when it comes to risk, okay, it is a low risk, and liquidity. Okay. When it comes to liquidity, forward contract has a low liquidity, but future contract has a high liquidity. Okay. We will see what is the major specification in the future contract. Okay. You know the expiry. Correct? You know the expiry. But in a forward contract you can alter it or modify. So if you want to carry forward till you can understand the word of carry forward, you can extend up to next 1 month, 2 months, like that. Correct? So basically, but in future contract, you know what is the expiration date. Okay. After the expiry of the future contract, the final settlement or delivery is made according to the rules laid down by the exchange. You understand what it is? Okay. So basically after the expired, okay, after the future get expired, so what is the procedure to deliver or settle the amount? Already pre-specified. Understood? Already pre-specified basically. Okay. So here, okay, and moreover, okay, so contract size, lot size, okay, and what is the minimum amount? So basically lot size describe, this is what it only 25 quantity you need to take it, or 15 quantity you need to take it, or 50 quantity you need to take it, or 125 quantity you need to take it. Already previously it is available, and you don't need to change anything. So according to that only you can able to take it. So initial margin is the minimum collateral required by the exchange before a trader allowed to take a position. So that is what I told you before. Okay. So tick value. Okay. So when it comes to future, tick value is very important. Okay. So basically tick value refers to minimum profit or loss that can arise from the holding a position of one contract. You understand? Okay. You will understand what is tick value first. Okay. So tick value depend on the size of the contract, and it is tick size. So every future had a tick size. Okay. So tick value is equal to contract size into tick size. Okay. So tick size, you might have noticed while you are seeing bid and ask. Correct? Okay. Bid and ask, some stock will move, okay, 0.5, 0.10, 0. So most probably it will move like this. Some will move 0.1, 0.2, 0.3, 0.4. Okay. So that means to say it has a 0.1 as a tick value, which is the stock moving is 0.5, 0.10, okay, 0.10, 0.15. This has a tick value of 0.5. Some stock moves, okay, 0.10, 0.20, 0.30. This has a tick value of 0.10. So that is what we call it as a tick value. So basically tick size, okay, the price can go up or down, increment or decrement, 0.5 only. If it is 0.1, it can go or up or down 0.1 only. Okay. So you understand what is a tick value in future. Okay. Limitation. Okay. What are the limitations we had in a future contract? Okay. So, okay, basically what are the risk we had, that is why we call it as a limitation. Some investment strategy, okay, can lead to the high risk or high heavy profit and losses, okay, due to the leverage provided in the future contract. So some investment strategy can lead to the high risk. That means to say what, it can make you heavy losses, okay, it can make you heavy losses. And moreover, okay, only partial hedging you can do while using the future contract, okay. So remaining things, it will go to the option, basically it will go to the option. So we will go in upcoming videos, we are going to check how option work, what are the options we have, like this concept, okay, we are going to check it. So let's understand, okay, what is the future contract. The consequences of low commission charges can be over trading by traders. So basically that is why we are losing the money, that is what they are referring, over trading by the trader because of the low commission charges. So maybe, okay, so this is what they are referring it actually, okay. So these are the limitations when it comes to future contract. But the same time, what are the benefits in the future contract? Basically this is a risk diversification, correct, okay, because we hedge it only to reduce our risk, okay. And highly liquid, as we told before, it is highly liquid because it is online and doing by multiple people, correct, okay. Higher leverage than any other stock. If you are buying a stock, okay, only if you are buying it in intraday basis, only 5 times margin required. But if you are, okay, if you are trading in a future, if you check, okay, for example, if nifty is trading around 25,000, okay, 25,000, now it is almost 26,000, okay. So 26,000 hit, okay. So if you are if it is trading around 26,000, if you calculated multiply into 25, so almost 6 to 7 lakh rupees might come, okay, 6 lakh 50,000 rupees come. But our margin required is only 75,000 rupees to 1 lakh rupees. So compared to the stock, it is most probably higher leverage we get it. And there was a calculation, I will let you know, okay, in upcoming videos most probably. And lower risk than buying and holding the stock, okay. So basically this has a lower risk. Only you need to predict what, okay, either it will go up or either it will go down. But that has a very lot of question. Maybe if you don't know how to do that, okay, so you follow the videos and previously I updated, okay, so that you will get to know basically, okay. And easy to trade, okay, because basically only you have a two option, either it is a buy or either it is a sell, correct, okay. So that is what I mentioned, short side or long side. Long in the sense buy, short in the sense sell, okay. Only you have to study one index instead of 100,000 stocks. Only if it is a nifty, only nifty you need to study. And only if you are doing technical analysis, only nifty technical analysis you need to do, correct, okay. Volatile than single stock, and it compared to the stock, future will be more volatile, index future will be more volatile. That is what we mentioned. So these all are the future and benefits we had it. If they ask the question, okay, so what are the benefit in an index future, this is what you need to answer. So basically this is what we need to know for today. And if you have any doubts regarding the same thing, please ask me anytime so that I can give you the more clarification. Thank you so much. Have a great day.